Welcome back to another video. So today we're gonna go over essentially my strategy. Okay, so I'm gonna make more in-depth and detailed videos of identifying exactly what I look for when I approach a trade or take a trade. But today we're going to essentially talk about like the strategy. Okay, so first of all, you gotta know that we have retail traders, me, everyone who's trading, and then we have the hedges and the banks, right? So essentially those are like the bigger players, or you could just like the 1% rather than the 99% right there in general. Okay, so they have large amounts of money to trade with, which allows them to move a market in whichever way they want, right? Now with this strategy, the goal essentially is to, instead of trying to, catch the retail trades, we look for what the banks would want to do with that money and where they would want to drive the price and why, right? So, first thing we're going to start off with is essentially liquidity. Okay, so what liquidity is essentially it's money that's sitting in a certain zone, right, which is pretty much created by people's stop losses, buy stops, buy limits, buy stops. Just that. Essentially, all those types of limits that you have, right? So you have buy stops, sell stops, buy limits, sell limits. Okay. Now, I'll go over that in a separate video. But so essentially, where those are located for retail traders, what the banks usually want to do is to drive the price that way before they take it another way. Okay. Now you would wonder, why would they want to do that? Okay. Well, the reason being they want to do that is because that would allow them to throw more money into the market on top of them already taking other people's, aka retail traders, money. Okay, so essentially their goal is to rob everyone who thinks it's going to go one way, and then it's going to go the opposite way. And now what that causes people to do is it leads them to treat trading like a gambling situation. Okay, because if you think about it, right, if you saw something that you almost predicted in a market, and let's say realistically you don't know how to trade, or you don't know how the banks trade nor move the market, right? So let's say you place that stop loss under a trade that you're about to take, and then the price is driven through that stop loss, you're taken out of the trade, you just lost money, and now it's going to shoot back up, right? It shoots back up. You thought it was already going to buy, right? So what does that like in your mind create? It's, oh, hey, I almost had it, right? And that's the problem with a lot of traders, is they don't know how the banks move the markets, and they don't know how to instead ride the wave with the banks rather than trying to be the retail trader that thinks they know everything when they already learned, everything that's on the internet, and you got to think about that. Everything already that's on the internet usually is seen by millions of people, right? Every typical strategy, some strategies work for other people that don't work for me. I'm not bashing on other strategies. It's just, for me, I'd rather take a trade, with minimal loss compared to a trade with huge loss. Like I trade, I'm in group chats, obviously, and I have people send me markups sometimes, and it's like, okay, you got a 300 pip stop loss, right? Now think about that, 300 pips, depending on your lot size. I'm talking about Forex right now, not stocks. But even with stocks, depending on how much you want to lose, right? 300 pips in the market could be worth a lot of money. When I, like, for that, in Forex, for example, which is like one of the main things I trade, is 300 pips on, let's say, a standard lot size, which is a 1.0, right? That's $10 per movement. 300 pips times $10, that's $3,000 that you're affording to lose on a trade that might make you 1,000 or 200, but you don't know how much it's going to make you because you don't know how to identify where banks want to move the market. And that's another reason why I think this strategy is very valuable for people to learn, because realistically, where the banks want to move the price, so you could take your profit there, and then you could find another re-entry. because banks will always come back for a second, third reentry before they move it to the true point where they want to move it. And that leads to certain time frames, right? You got to keep in mind, looking at or through time frames, it's like fractals, or like you ever look through like a kaleidoscope and you have like just multiple things going in and out, right? You got to picture the market that way. The same way the market moves on a bigger time frame is the same way it's moving on a smaller time frame as well. Okay, and that might just blow your mind, but it's literally the same thing. And this strategy, it's applied on every single time frame. And it's the craziest thing, you see it happen, and then you realize that the same thing happens over and over and over again. What does that lead? Oh, sorry about that. Like, what does that lead you to believe? You know what I'm saying? So the strategy works. I've been trading AMC with it. It's been pretty much moving exactly how it should based off that strategy. I'm not going to get into AMC this video. I'm going to have another video about that and like what happened this week and everything. But this strategy works for that. It works for crypto. It's everything. It's pretty much learning the strategy of the 1% of the banks and how they move the market. So getting into the next thing. Okay, so now we're going to talk about like not liquidity, but like I explained earlier that liquidity is trapped money, right? Buy stops, sell stops. I'm gonna get into into the explanation of like where to identify it in a little bit, but I'm gonna talk about some other things as well. So, like I said earlier, the banks need to grab that liquidity to move the market a certain way, along with take people's money, aka retail traders. Okay, so now we're gonna get into identifying that. Okay, so where do you identify liquidity? Okay, so right now I'm using USD CAD, US dollar versus Canadian dollar, as a prime example, because this pair right here is just, I'd say, one of the biggest like perfect examples of like essentially smart money concepts. Like it just works out perfect. Okay, so liquidity, right? So entries, right? Taking your entries, buy, sells, right? They're going to be based off being able to identify liquidity, right? On top of identifying candles. I personally have learned them to be called institutional candles. Lining up with that. And then you're going to be using imbalances, gaps, the common thing, market gaps. Obviously it's got to be filled at some point. That's another thing, right? So I'm going to get into explaining liquidity now. So we have liquidity, right? So your common trader, right? Double tops, double bottoms. I'm going to go through some images, right? Your typical trader, right? Double top, right? You have your double tops. You have your double bottoms. You could have your triple tops. You could have as many top bottoms you want, realistically. I mean, it doesn't matter because eventually those get screwed. Okay? Now, I am going to tell you this. Sometimes, yes, it does respect it off that. But for me, personally, I'm not that trader to take that entry. I look for confirmations based off everything I'm about to show you, obviously. But I wait for those confirmations to play out rather than me trying to take the market on as a retail trader, right? So you have these, and then we'll go over common, like different types of charts, right? Or charts, not charts, patterns. I'm sorry. Okay, so common trading patterns. We have all of these. Okay, so I'm gonna be honest. Sometimes I do use these, right? But the only times I will use these is when a market's playing out a certain way, because I'm not gonna lie, the market does move in that way as well. But the thing is, like, to get that perfect entry, I don't want to take the entries based off these charts, right? I want to take the entry where the banks start the movement. Okay, I'm shooting for that sniper shot, that like perfect entry, okay? I'm not shooting for your common entry as like a common trader, okay? Like we're trying to be built different over here, okay? So you have your common charts, right? Double bottom, inverse head and shoulders. Yes, the market does move like that. But my strategy is gonna, or not even my strategy, but like the strategy I've learned along with everything I've accumulated over the 4 years that I've been doing this. Combining all of that, it just happens to work like every time, and it's the craziest thing, okay? So, you have these, obviously, and like, personally, I do use them sometimes. On AMC, I took a call, and it moved just like that, and it does happen. It can be applied. But, like, that's only one element of everything you'd want to know about the market, okay? So, back to identifying liquidity zones. So, liquidity zones essentially are zones where they have equal highs and lows, okay? So, use this little rectangle here. I'm going to identify some equal highs and lows, right? Double top, right? Common thing called, right? This, when the price comes back here, typical person's going to probably think, oh, hey, it's going to sell off this zone, okay? For the way I see it, you got to start seeing it different, right? You got to think outside the box and think outside of the common trader, because the common trader doesn't make the money you're going to want to make off this market, right? So we have that double top over here. Beautiful, right? I'm already on the daily time frame. If we go back to the monthly time frame, we can see that obviously isn't the highest point. Over here, realistically, I would maybe over here I'd call a double top as well. We have a top, double top here, whatever. The candles and wicks, like some people do equal highs and lows based off, or like candles and wicks, or like the body, making sure everything. For me, it's just, if they're within the same range, like fairly close, I'd consider that like a zone of like liquidity, okay? So we have that there. We have that here, right? Then we'll identify some lows. Right now it's creating some equal lows in the market as well. Today close out Friday, creating some equal lows. More equal lows here. More equal lows here, right? This is just on the bigger time frame. If you're to zoom in on it, like I said, this is like fractals. If you're to zoom out on it, you're going to be able to identify it on a smaller time frame, which is used to get your entries, okay? Bigger time frame shows bigger picture. Smaller time frame shows where you want to get your entry and where you want to get that like precise entry, okay? So, double top, quadruple top, what the hell you want to call it. It doesn't matter. It's all equal highs and lows, okay? So, what liquidity is, essentially, okay? Let me get my little dollar sign up in here. You need to change the color of that. So what liquidity is essentially the trap money that's sitting over here. And by trap money, like I said earlier in the video, I'm talking about those stop losses, or those buy stops for it to continue moving. I'm talking about that. Okay? So picture it like this, okay? If you were the common retail trader, you were to take this trade based off that double bottom. Like, for example, right now I already know somebody already took this buy off this double bottom because, oh, hey, it formed double bottom, it's going to buy up, right? I already know someone today, or, last week, I already know somebody probably took that, okay? They probably took that buy. For me, that's not a buy that I would have wanted to take, because I see the market obviously going lower, okay? Not going to say why right now, but we're going to continue talking about that trap money, right? So you have that trap money, right? Common trader, take it right there, right? Like I said earlier, you have to think outside of the box. So what would the banks want to do? This whole strategy theory is based off like thinking about it, how a bank would want to move the market, okay? You got to think like the banks. You got to move like the banks, okay? Because the banks make the money, right? 1%. I'm sorry. Like, either you want to be the 1% trader or you want to be the 99% trader, okay? Choice is yours, right? So what would the banks want to do? Realistically, what the banks would want to do, right, is bring the price down, Geez, not that one. Arrow. So essentially what the banks would want to do is bring that price down and then bring it up, right? You know, you break these equal lows, you take everyone's money, and then you move the market to where you realistically wanted it to go, right? So, with that being said, what I'm going to show you now is how to get those entries, right? So the first step of this whole strategy is being able to identify the equal lows, equal high. I pointed at the wrong one, but equal highs, equal lows, okay? You have to be able to identify all that, okay? So that's the weekly frame. You know, obviously, there's a big picture being painted over here, okay? So now we zoom in on a smaller time frame, okay? So over here, you know, easily you could identify the equal highs, equal lows, right? Like this is what people call consolidation, when the market kind of moves like up, down, left to right. Okay, this is something you never want to trade. Don't be an idiot, because you're going to get caught up in being the trap money, and then you're not going to know which way it's going to go, because majority of people don't, you know. So do not trade consolidation. That's one rule for sure that I'd like to tell everybody. Okay, so obviously you have those equal highs and lows, right? You go to a bigger time frame, those are identified, right? Next thing you're going to want to do is you're going to want to look back in the past, right? Because when the market moves, sometimes it creates these gaps, imbalance, institutional candles, where the market's going to move to before it goes up another way or goes down the other way, right? And why would you want to do that, right? It's because you form this picture, right? The banks form this equal high, equal low consolidation for a reason, okay? Because they know that they're going to screw people with it, okay? But not us. Why? Because we know what we're doing, okay? So you see the 4-hour time frame. Obviously, you go back in the past. You don't see it there. Go to a bigger time frame to identify another potential zone, right? So now we're back on the daily. That was the 4-hour we looked at. 1 hour, it's consolidating. Now you're going to wonder, where is this going to go, right? So now I'm going to speak about what institutional candles are, what is an imbalance, and what is a gap, okay? So I'm going to start with gaps, because gaps are like probably the easiest thing that you could identify. Like it's not hard. So we're going to go on a bigger time frame again. See if we could identify something, you know, maybe a gap or something. You know, if you don't see one on a bigger time frame, smaller time frame, you know, let's try the hourly. Once again, so prime pictures. Let's search this, baby. Let's see here. Maybe 2-hour frame. We could find something. Okay, primo example of a gap, right? We have a beautiful gap. Okay, this is a gap. This is as simple as it gets. Gaps have to be filled. Okay, on market opens and everything, they could potentially not be filled right away, which allows them to be a target zone for banks to fill, or, you know, just move the market towards that way. Okay, so this is a gap, simple as that. Like, it doesn't get any harder than that. Those are gaps. Okay, when you see those on certain time frames, let's say the market's moving that way. Let's say you see a gap here. Let's say this whole area right here was never existent, right? On the 2-hour frame. For me, there's a gap right there. I already know the market's going to probably come down and fill it, at least to the top, for example, of these highs, or it can continue down, you know? So that's one thing already. So that's the gap. The next thing we're going to look at is essentially what I call a institutional candle, okay? So what an institutional candle is. Perfect example, right? Obviously, this is still consolidating. You know, you could have taken like a trade here, just made small pips using this strategy. This could be used on small frames, big frames, swing trading, you know, day trading. You could use this in scalping. You know, me personally, I don't scalp because I hate watching the market all day. Okay, So what an institutional candle is, okay, ready? It's as simple as this. So what an institutional candle is essentially a candle. It's the last candle before a movement, like a huge movement up towards a different direction, okay? So for example, for like a big buy to happen, that last sell before the buy. If there's a big sell to happen, it'd be that last buy before the sell, okay? So now we're going to identify that right now. So let me just trash everything here. So let's identify, right? So the last sell before the huge buy, okay? So we have this last sell right here. Hopefully you guys can see that. This last candle, that last sell before the buy, right? So that'd be an institutional candle. And say a big movement downwards, right? So that'd be a buy example, where it's going to buy up. A sell, huge sell right here, right? This last buy before this sell, okay? That would be an institutional candle, okay? With that, okay? Now you're gonna wonder, okay, what does that mean? Like, what does that do for me? So that, right? So like I said earlier, we have different types of target zones, right? We have those gaps. Now we have these institutional candles, okay? So that'd be one. So now this is a zone, right? Now using this institutional candle theory, usually you'd want it to be like on a buy before the sell, right? You'd want it to be about 50% of the body to that inside wick, right? So that'd be a target for a future movement, okay? Right? So that'd be example there. Now if we go back over here to our little sell run right here, right? This last body, 50% of the body to the inside wick, right? Another target zone for banks to bring it down before either it's been tested there before it continues moving up already, or it hasn't hit that area, which allows it to be an entry point. Okay, so this is an entry point on a continuation, and it could be a fresh entry point on a, just the start of a movement towards the other way, right? For example, right here, this would be another entry, right? You see that it went down into this zone, right? It went up. Ooh, wonderful, right? It went back down. Okay, it went into this candle, okay, which is fucking beautiful news, right? That's another entry you could have taken and continued riding it up, okay? So that's perfect, okay? That's what you want. You want, it's either gonna do this and then continue that movement, right? That's another entry, or then you have that, that last sell before the buy I was talking about here, right? Now, if I were to look on a bigger time frame here, right, paints a bigger picture. Currently, this has not gone here, right? You have equal lows here identified. This hasn't been hit. So for me, eventually this is going to buy to here, right? That area hasn't been tested, right? So when using this institutional candle to look for an entry, you got to keep in mind that you're not going to be just like, hold on, I'm trying to think how I want to explain this real quick. Like, you got to keep in mind that if it hasn't been, like, if it's been filled already, like I showed you over here, this one's been filled already, right? On a smaller frame, obviously, like this big wick. I mean, it cleared liquidity here, so obviously that's why I continue buying up, and it smacked down, continued buying up, so this could be a potential buy right here. But I'm not gonna get into that. I'm sorry for getting distracted. Like, that's just so easy to identify, like, once you know how to do it, right? But so it went up, came down, started moving up, right? This one hasn't been filled, this one has been filled, right? So that's a target zone where the market could move in the future, okay? This one's already present movement, okay? That's present, this is future targets, okay? Now those institutional candles, usually to make them like extremely like valid and be useful, you want to make sure those have already cleared liquidity, Okay, so once you identify that liquidity zone, next step, add that institutional candle into there. Okay, why would you do that? Because, hey, you identify that liquidity, right? And then you have that institutional candle before the big movement down. Okay, so that institutional candle, really make sure it's valid. It's that candle, right? This is a bigger time frame. That's why this one's bigger. But like I said, fractals make that perfect entry. Okay, keep in mind. Okay, so these originally right here were equal highs. Okay, so this candle blew it out of the water, right? So liquidity grab, which is essentially what the banks do before they move the market in the other direction. Usually it's between 10 to 30 pips on, your common Forex pairs like USD CAD, Euro USD, all those, just your common, realistically any pair with the USD or just any Forex pair for this one. Usually that's between 10 to 30 pips. I've come to see that on like NASDAQ and like US 30 and like bigger movers that like have more pip movements than like your typical Forex pairs. Those bigger movers happen to be bigger, maybe like 100 to 300 just because they move that much more. Okay, so clear that out, drop down, right? For me, an entry would have came off over here on a smaller time frame. I'm willing to bet, like I was saying, this is like fractals, so I would have identified these two things on top of that, threw it back in there, and have used it. Okay, so the next thing, okay, you have those institutional candles, right? You have a target here. This one obviously was already filled. That liquidity over here was killed, made this one valid. It now came back down for another entry. What the banks want to do, right? That's how I know. Usually that's a confirmation of it continuing the direction it wants to move. Okay, so we have that movement. Now it's going to buy up. Obviously here it created equal highs, so I already know it's going to be going above this. Okay, so the next thing, right, would be an imbalance. So that's another target zone for entries, take profit zones. Now keep in mind, this is used for take profit zones and entries all day, right? So what is an imbalance? Imbalance is just honestly one of the easier things, like for example, for like I was talking about gaps. So what is an imbalance? Okay, so an imbalance is essentially a candle where the body doesn't have wicks going into it. So essentially what it is a huge market movement. So example right here, right? Bingo, right? This one, obviously, let's ignore this section over here from here on. This one never had a wick. So this is normal market structure where it has wicks going up, down, up, down, up, down. Big movements like these, big movements like these aren't normal in the market, right? So that creates imbalances, which are other targets for banks to push the price to before, either continues buying or it doesn't. Okay. So imbalance right now, obviously this price over here, after creating those equal highs, right? Another target zone, right? This price came into this imbalance and went down. Right now, would I consider this an imbalance being filled? Usually what I like to see on imbalances is for them to be filled at least 50% of the body of the whole wick. Okay? So this one realistically hasn't been filled. It forms another target zone. This little wick right here, in the future, create a double top from there, create liquidity above that zone, and the price can be driven up to here and then sold off. Okay? It's multiple things that come into thinking like this, but once you can identify, get it on the smaller time frame, you'll know what everything's doing. Okay, so over here it created equal highs, right? This candle right here, just a 4-hour frame. I'm willing to bet if I were to make that a smaller time frame, I'm not going to do it right now, but there's going to be equal highs that this candle bursted to. So now this institutional candle over here, right, 50% of the body to that inside wick of that zone. That already is another zone where it could buy to and then sell off that zone. Okay, so this could have been essentially the move here, right? Dropped down, went back up, dropped down for another entry, made that triple top, so people think that, hey, it's going to go over here and then sell down, and realistically you have that other candle over here. Once again, that institutional candle lining up over here that has not been tested once again, and then you have another entry potentially forming over here to go through those highs, and then it could sell back down off that and then move up. You know what I'm saying? Like, the bigger time frame is always going to show you the bigger picture of what's actually going on. The smaller time frame is going to show you those plays that are like happening right now and then, and like this would be for like scalping, you know. So the bigger time frame shows like the bigger move. Okay, so wherever imbalance, you know, we have that, you know. So, you know, let's combine all three, right? So liquidity formed, right? It bought off here. This one's canceled out. This one right here hasn't been bought off yet. So for me, I could see a potential third entry over here by the banks before they go through these highs, right? And then it could sell back down from here, test the highs, you know, maybe a order block, about to get into that, and then continue on its way up to maybe this imbalance, or it can continue up because obviously you see equal highs, imbalances, you know, and that's just more target zones for where the banks want to move it to. Okay, so now, right, say the third step, right? So, well, not even the third step. Another thing would be they're called order blocks. So essentially what order blocks are, like on a big movement, are essentially that one, like, see this whole sell down here? So what an order block would be within this whole sell movement, it would be these little candles right here that essentially were like essentially a little move the opposite way before it continued moving down towards its real natural movement that were, well, not even natural, the banks are forcing it, but it's real movement that it's going down towards. Okay, so order blocks, it's just literally like my red candles are sells and white ones are buys, but you know, order block essentially would be, where's a big move upwards? So bingo, right here. So we have that big essential move through here, right? Order block would be right here. Okay, so that's another entry zone, or like another target where banks can move the market in an opposite way. So now we're gonna go back to smaller time frame, trash everything. So now, you know, once you're able to identify those three, you know what those look like. I'm gonna make videos more in depth of just posting examples of what everything looks like, just one by one. You know, I'm gonna have a playlist separate for that for you guys. But you have that, you know, say I didn't delete everything, you know, kind of did it, whatever. So now the next thing is being able to combine all of that together, okay, with the use of a Fibonacci retracement. Okay, you could have your patterns and everything, but with a Fibonacci retracement, being able to combine all those things I just told you guys is going to allow you to have the best entries. Okay, so now how to use a Fibonacci, right? I'm not going to go into detail on that. I'm going to make a separate video for that for you guys, but essentially, let's say I pull up my Fibonacci, you know, usually you want to do most recent low to the most recent high, right? So for example, it would be from here to here, okay? That's your most recent high, low to high, okay? We have these levels, okay? So what these levels means is essentially a percentage of a retracement, okay? Which is not, it's nothing too crazy, okay? You know, it's numbers. You don't need to know how to count. You just need to know how to look at these levels, okay? So we have our 0.5 level and our 618 level. I usually do not trade off that. Sometimes it is respected during the market. Reason being is because retail happens to trade off that area in the market. I usually do not trade those. That's why I have them in a lighter color. Kind of ignore it, okay? I think I have one turned off, actually. One sec. Here are my fib settings. You guys can pause the video and obviously do it, but I happen to have 0.71 turned off. Is it turned off? Oh, 701, so 0.71. But I don't know why that's not showing up. Okay, so the zones I trade off the Fibonacci usually are 0.711, 0.72, 786, 84, 886, 9394. So I have them different colors. The 9394, it is respected. Those are usually the like super snipes. If it hits that zone, I'm talking you could have like a 3 pip stop loss, right? So on a 10.0, that'd be $30, and this movement can make you $1,000, $3,000. A lot bigger than money, right? And it can make you that much money off a low stop loss, right? So then you have your 886, 884, and 786. Those are another very good area of zones. 711 and 72 usually are respected as well. For me, right, how do I use the Fibonacci when I trade, right? So what I look for is the Fibonacci usually to line up with that institutional candle. When the Fibonacci happens to line up with an institutional candle, right, I put the stop loss, for example, right, let's say an institutional candle was here. So for me, hey, I'm looking for an entry for the continuation of the buy, right, because look what if I were to put this one lower here and then drag this one up to the high, right, what you see is this came down to that 0.84 area right before it continued up, right? So your safest entries, your safest entries without trying to predict where the market's going to go are going to be based off those retests before the banks really move the market the opposite way, right? So this one lined up with that 0.84 area. So for me, usually when the Fibonacci aligns, like let's say none of this existed, I would have been waiting for the market to go between the 786 and 94 area. Okay, that's how I know it's going to be an entry. But if we have that institutional candle to the left in the past that happens to line up within these zones, it allows it to be a more respectable play that you'd want to take. So for me, this would have been a beautiful play to take because, I probably would have put, if like 50% of this, like inside of this wig, this body's not so big, but for, probably smaller time frame, it's probably it's a lot bigger and you'll be able to identify it a lot better, okay? This probably would have lined up perfect. I would have taken that trade with a stop loss of maybe like 2-3 pips, okay? You think about that, you throw a bigger lot size, let's say you throw a 10.0, which is $100 per pip, you know what I'm saying, a 2-3 pip stop loss, which is $200-$300, versus you being able to make, a ridiculous amount of money off that. I'm not going to go into like how to count pips and everything. I'll make a separate video on that. Just this video's already long enough. So that would have allowed it to be a perfect play. Would have went off that. Okay, so I use the fib with those institutional candles or order blocks or imbalances, and I combine those two together on top of being able to identify where the liquidity is, and that's how I figure out where I'm going to enter the market and when. If it doesn't align, I'd rather wait, because you can't get greedy with this, and there's going to be unlimited opportunity in the market all the time. Like, the opportunity's never going to stop. This shit's always going to be trading for the rest of your life, no matter how old you get. Why? Because you already have cryptos. You could trade cryptos like this. Okay? Cryptos move exactly how everything else moves, and like if crypto's already being able to be traded, you have Bitcoin to USD, BTC USD. If that's already happening right now, or you really think this market's going to go away, no, it's never going to go away. Okay? So, you have that, right? So, that's going to be the end of today's video. I'm going to go and probably record some videos on how to identify everything, having a lot better, like a better eye for it. To develop a skill, it takes time to develop that like real eye for everything, so you could just kind of do it. Like for me right now, I could kind of, without even using the Fibonacci or anything, I could pretty much like identify where it's going to go to, So, Jesus, I'm running out of breath. But with that being said, I'm going to make other videos explaining everything that I've shown today. This was just an example of the strategy being used. I'm going to obviously make more videos on it. And another goal on top of that's going to be to start live streaming for everyone to see it in action, and you guys could potentially take the trades too. Okay, so I hope you guys have a wonderful day. I hope you guys kind of learned something. Obviously, I'm going to get into more detail, but that is it for now, and have a blessed day, guys.